Hello traders, Gary Wagner here, 1:35 in Honolulu, 6:35 in New York on Thursday, 9th day of February 2023, and this is the daily report for gold and silver. The uncertainty as to whether or not the Federal Reserve would make good on its commitment has now shifted to the reality that they will. That is what has caused pressure in gold prices since Thursday of last week. If you recall, gold lost $90 in trading between Thursday and Friday, moved up Monday, Tuesday, and Wednesday, but that reality again stuck in with gold losing $18.60 after opening at $18.9180 and settling at $18.7320. The dollar had only a fractional input, having very, very mild tailwinds, with the dollar declining by 0.15% and the index settling at 103.115. The decline in silver was much stronger than gold's decline. It lost almost 0.5%. And after factoring in a decline of 47 cents today, the most active March contract is currently fixed at $21.95. Gold prices reached an apex, or its highest value, this year on Thursday of last week, trading to a high of $1,975. But over those 2 days, Thursday and Friday, gold would drop $100 and settle at $18.7680. And that is these two candles here. What we're looking at is 3 days, Monday, Tuesday, and Wednesday, and this Thursday's pricing. What is interesting and what we talked about throughout the week was the fact that the first 3 trading days had higher highs and higher lows, but very, very weak strength as determined by the body size, because in candlesticks, the larger that rectangle is, the stronger the force is taking it higher or lower. In other words, these large red candles were significant because it shows that there was a resolve, a pivot from bullish to bearish, and then it was followed by uncertainty. We saw higher highs and higher lows, but the body size was so small, as I mentioned in my commentary, it didn't really allude to the fact that we saw a key reversal and we would look at a return to bullish market sentiment. That was confirmed today when gold closed below what I believe is a critical price point, which is $18.76, and it is simply based upon a Fibonacci retracement level, the 38.2% retracement level. And on this, we are beginning at 1719 up to 1975, which represents the second leg of this rally. This is the first leg from 1618 to 1721, and then the retracement back down to 1719, which was the beginning of the second leg of a rally, or a wave 3 rally, which by nature is going to be the strongest of any impulse waves. They are waves 1, 3, and 5, with the conclusion of the largest wave, wave 3, occurring on Thursday at $1,975. The highest value that gold is traded to this year on Thursday marked the end of a third wave, but also the beginning of the corrective fourth wave, which is currently where we are. We have seen gold drop from $1975 to a current pricing of $18.71, and because it broke through this key level here, gold will most likely continue to sell off next week. So the question we need to ask and answer is, if in fact gold continues to decline, where should we look for potential levels of support? And to do that, I have marked out our targets of 1846 and the lowest level at 1816. They are Fibonacci retracement based, and they represent a 50% retracement of wave 3 and a 61.8% retracement. We've converted our candlestick chart to a Heikin-Ashi chart to further confirm our assumption that gold prices most likely will continue to drop. When we look at the pivot itself, it is a classic example of how Heikin-Ashi can aid a trader in determining it. And the pivot I'm talking about are these two candles. These large red candles represent Thursday and Friday when we had a $90 drop. In reference to Monday, Tuesday, and Wednesday, in a Heikin-Ashi chart, it is these three candles, and rather being illustrated as small green body candles, they are red. In other words, when we looked at a Japanese candlestick chart that contained three green small-bodied candles, that suggested some hope. However, the Heikin-Ashi chart maintaining red-colored candles confirmed that there was a greater likelihood that the correction would continue. Therefore, we do expect gold to continue to track lower now that it broke below this key level, and we want to see how gold reacts if it gets to 1850 or 1815, because a pivot at either price point is a strong indication that the correction has concluded, and we will then enter a final fifth wave. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.